Look around at the global economy today. Prices for everyday groceries keep climbing. Young people can barely afford to buy a home, and the news constantly warns us about impending recessions and inflation. At the exact same time, Wall Street trading algorithms are making millions of trades every single second, moving billions of dollars back and forth across digital screens. Modern finance promises us that these ultra-fast computers and complex financial products are creating wealth. But if that's true, why does the average person feel more financially trapped than ever before? Why does the global economy feel like a house of cards waiting for the next breeze to blow it down? What if the solution to our modern financial disaster isn't a new high-frequency trading bot, a complex stock market strategy, or another government bailout? What if the most stable, ethical, and profitable financial system on Earth was designed over 1,400 years ago? Today, we are taking a deep 30-minute journey to unpack a surprising truth. Why the core principles of Islamic finance don't just rival modern Wall Street algorithms, they completely outperform them in terms of stability, real-world value, and long-term protection for your money. And you don't have to be a financial expert to understand why. To understand why this system works so much better, we first have to uncover the dirty secret of modern economics, the difference between real money and paper money built on debt. In the standard financial system we live in today, almost all money is created out of thin air as debt. When a bank lends you money for a car or a house, they don't actually open a vault and hand you cash they already owned. They type numbers into a computer, create a loan, and charge you interest, known in Islamic economics as riba. Think about how interest works in everyday life. If you borrow $10,000 to start a small bakery, the bank demands that you pay back that $10,000 plus 6% interest every single year. The bank doesn't care if a snowstorm hits your town and nobody buys your bread. They don't care if your oven breaks down. Whether your business succeeds or completely goes under, the bank demands its guaranteed cut. This creates a massive imbalance. The bank takes zero real-world risk, while you take 100% of the risk. Now, multiply that single loan by billions of people, corporations, and governments. Today, the world is swimming in over $300 trillion of debt. In fact, if you add up all the stock market bets, derivatives, and paper claims floating around Wall Street, there is 10 times more paper money in existence than there are actual goods, services, and physical assets on the entire planet. This is where algorithmic high-frequency trading comes in. Modern Wall Street bots don't care about building real businesses, hiring workers, or creating products. They spend millions of dollars building hyper-fast computers just to trade these paper bets back and forth in microseconds. They make money off pure speculation, market panic, and microscopic price swings. They are essentially extracting wealth from the real world without creating a single tangible thing of value. It's like playing a massive, high-stakes game of digital musical chairs, and when the music stops, regular people are the ones left paying for the crisis. Now let's contrast this with the foundational pillar of Islamic finance. At its core, Islamic law completely bans riba, the charging or collecting of interest. At first glance, a beginner might ask, if banks can't charge interest, how do they make money? Why would anyone lend money to start a business? This is where the magic happens. In Islamic finance, money is not treated as a product that you can rent out for a profit. Money is simply a tool to measure the value of real things. If a bank wants to make a profit under Islamic law, it cannot just hand you a loan and sit back collecting interest while you do all the hard work. Instead, the bank must become your partner. This is known as mudaraba, profit sharing, or musharaka, joint venture. Let's go back to that bakery example. Under an Islamic financial model, if you need $10,000 for your bakery, the investor or bank buys a stake in your business. You bring the skill, hard work, and management, they bring the capital. If your bakery makes a $10,000 profit at the end of the year, you split that profit according to an agreement you both signed, say 60% for you and 40% for the investor. But here is the game changer. If a disaster happens and the bakery loses money, the investor loses their capital and you lose your labor time. Notice the fundamental shift in incentives. Because the bank shares in the loss, they will do everything in their power to help your bakery succeed. They will look at your business plan, offer guidance, and ensure you are making smart decisions. The system forces capital owners to share both the risk and the reward. Think about what this does to the entire economy during a financial crisis. In a traditional debt-based system, when a recession hits, businesses struggle to pay fixed interest payments. They are forced to lay off workers, slash budgets, and go bankrupt. Banks foreclose on homes, and a chain reaction of economic destruction sweeps through the country. In an Islamic financial framework, because investors share downside risk with entrepreneurs, the system has a built-in shock absorber. During a bad year, profits naturally shrink for everyone, but businesses aren't forced into instant bankruptcy by rigid interest payments. The economic burden is shared fairly, preventing mass liquidations and systemic collapse. This brings us to the second core rule that gives Islamic finance a massive edge over Wall Street algorithms: the total ban on gharar and maisir, which mean excessive risk, hidden traps, and pure gambling. In modern stock markets, trillions of dollars are traded every day in things called derivatives, options, and short positions. To keep it simple, these are financial tools that allow traders to bet on whether a stock will go up or down without actually owning the stock itself. Imagine two people sitting in a stadium watching a football game. Instead of buying a ticket to support the team or investing in the stadium, they sit in the stands and bet thousands of dollars on whether the quarterback will drop the ball on the next play. That bet doesn't help the team, it doesn't build a better stadium, and it doesn't create a job. It is pure gambling. High-frequency trading algorithms are designed specifically to play this gambling game. They create artificial market swings, trigger automated panic sales, and wipe out retail investors' savings in seconds. Islamic finance completely outlaws this. Under Islamic rules, you cannot sell what you do not own, and every single contract must be tied to a real, physical asset. Whether it's a real estate project, a shipping container of goods, a solar power grid, or a local business, every financial transaction must be anchored to something you can see, touch, or verify in the physical world. When you enforce this rule, you instantly destroy the ability of Wall Street algorithms to create fake, synthetic market bubbles. A computer algorithm might be able to artificially manipulate the paper price of a digital stock option, but it cannot fake the physical existence of 100 tons of wheat, a fleet of delivery trucks, or a functioning apartment building. By anchoring money directly to real-world production, Islamic finance strips away the fake noise that causes market crashes, flash panics, and artificial inflation. To see proof of this in action, we don't have to guess. We can look at modern economic history. Cast your mind back to the global financial meltdown of 2008. Major investment banks that had been around for over a century collapsed overnight. Why did it happen? Because conventional banks had bought trillions of dollars of toxic fake financial assets, subprime mortgage packages, and complex paper bets that nobody truly understood. When the house of cards collapsed, millions of families lost their homes, their jobs, and their life savings. Do you know which financial institutions walked through the 2008 crash virtually unscathed? Islamic banks. Because Islamic law strictly banned them from holding toxic paper derivatives, short-selling contracts, or predatory subprime debt packages, they didn't hold any of those fake assets. Their balance sheets were backed by real houses, real infrastructure, and real commercial businesses. While Wall Street algorithms were executing emergency panic sells and wiping out wealth, Islamic financial portfolios remained stable because their assets held real, intrinsic value. Now, let's bring this down to a practical level for anyone wanting to invest their money today. How does an Islamic approach to the stock market actually make you a smarter, safer investor? To ensure a company is ethically sound for investment, what is known as Sharia compliant, financial experts run every public company through strict mathematical screens. And these screens double as one of the best financial safety filters ever created. First, there is the industry filter. The company cannot make its money from industries that harm society, such as gambling, alcohol, adult entertainment, weapons of mass destruction, or interest-based banking. Second, and most importantly for your wallet, there is the financial ratio filter. A company cannot hold excessive amounts of debt. Generally, if a company's interest-bearing debt exceeds 33% of its total value, it is instantly disqualified. Think about what this filter does for an average investor. When central banks raise interest rates to fight inflation, what happens to traditional companies loaded with debt? Their interest payments skyrocket, their profits evaporate, and their stock prices crash. By following Islamic investment filters, you automatically avoid companies that are drowning in dangerous corporate debt. You are forced to invest exclusively in solid, well-managed companies with strong cash flow, real products, low debt, and durable business models. In mainstream finance, legendary investors like Warren Buffett spent decades teaching people to avoid heavily indebted companies and invest only in strong, fundamental businesses. What Wall Street calls quality investing or value investing, Islamic finance hard-coded into its legal framework 14 centuries ago. Modern algorithms spend millions on computing power to search for safe, low-risk stocks, yet the rules of Sharia give you that exact safety net by default. Now, let's address the modern world of technology, artificial intelligence, and cryptocurrency. How does Islamic finance fit into the digital age? For a long time, critics assumed that asset-backed ethical finance was too slow for the fast-paced modern world. They thought that avoiding interest meant staying stuck in the past. But today, the exact opposite is happening. The explosion of Islamic fintech, AI, and smart contracts is revolutionizing global business. Take blockchain technology, for example. What is a blockchain at its simplest level? It is an open, tamper-proof digital ledger where transactions are recorded clearly for everyone to see without needing a middleman. In classical Islamic law, every contract must have total clarity, wada. There can be no hidden fees, no fine print traps, and no ambiguous terms that trick one party. A smart contract running on a transparent blockchain perfectly enforces this principle. It automatically verifies asset ownership, executes profit shares fairly, and prevents double selling without letting a bank take a hidden cut of interest. Furthermore, developers are now building AI-driven, ethical investment platforms. Instead of an algorithm pushing high-interest credit cards or high-leverage trading accounts on everyday people, new Islamic AI engines analyze small business inventory, real estate market trends, and supply chain data. They help investors pool their money together to fund real-world entrepreneurs in fair, profit-sharing partnerships. The algorithm works for the human instead of exploiting the human for interest payments. This highlights a profound difference in philosophy between the traditional Wall Street model and the Islamic economic model, extraction economics versus generation economics. The mainstream financial system, driven by speculative algorithms and debt creation, is an extractive model. It acts like a giant vacuum cleaner. It extracts wealth from working-class people, small business owners, and developing nations through compound interest and inflation, funneling that wealth upward into the hands of a tiny percentage of capital owners. It doesn't care if the real world suffers as long as the paper yield keeps flowing. Islamic finance operates on a generative model. It acts like a garden. Because investors are legally required to take on real business risk alongside the people they fund, they are directly incentivized to see that business grow, innovate, and thrive. Wealth is generated through genuine human creativity, real trade, and productive labor, and then shared equitably across the community. This is precisely why major institutional investors, pension funds, and ethical funds around the world, both Muslim and non-Muslim, are rapidly adopting Sharia-compliant investment frameworks. They are realizing that in a world drowning in fake paper debt, volatile crypto scams, and unpredictable market crashes, grounding your wealth in real-world assets and ethical rules isn't just a moral choice. It is superior financial survival. As we look toward the future of the global economy, one thing is becoming crystal clear. A system built on infinite debt, fake paper bets, and predatory interest cannot last forever. Eventually, reality catches up with the math. The future of money will not belong to hyper-fast algorithms that gamble on market panic at the speed of light. It will belong to transparent, ethical, asset-backed systems that put human dignity, fair partnerships, and real-world productivity at the center of commerce. Whether you are an experienced investor, a small business owner, or someone simply trying to protect your family's financial future, understanding these timeless economic principles gives you a massive, unfair advantage in a chaotic world. Does the concept of zero-interest, asset-backed finance change how you think about modern stock markets and economic stability? Let me know your thoughts in the comments below. Don't forget to hit that subscribe button to keep upgrading your understanding of money, technology, and reality. And I will see you in the next video.